Hi, both. Thanks for joining us today on our Business Gurus channel, where we will be discussing key business topics to help students grasp the most important elements of their course in preparation for their exams and future career. Let's get started.
Welcome back to the Deep Dive. Today, we're really getting into something huge, something core to, well, ambition, I guess. Scaling a business.
Right, that leap from startup to, global player.
Exactly. Every founder dreams about it, but that dream, it slams right into a big financial wall. So today, we're tackling that bottleneck,
Mm.
the money problem.
The big money problem.
Yeah, because look, if you want to do something truly game-changing, like I don't know, develop a revolutionary new product line that costs maybe billions in R&D.
Or maybe acquire 3 competitors across the globe, something really aggressive.
Right, the kind of money you need for that is just staggering. Your
Yep.
standard bank loan or just reinvesting profits, it's
Yeah.
often not nearly enough.
And not even close. Not for that kind of transformation anyway. It's too slow, too small.
So we dug into the sources you shared, looking for how companies make that jump. And there's this key pivot point, this huge decision.
Ah, you mean going public?
Yes, transforming the business from a private company into a public limited company, a PLC.
And that is a massive strategic shift. It's really the focus of our mission today, isn't it? To unpack what that actually means.
Definitely.
We need to look at how becoming a PLC actually raises capital, because it's way more involved than just asking for cash.
And the trade-offs. We have to talk about the trade-offs.
Oh, absolutely. Critically important, because you get immense power, yes, but there are some pretty serious dangers baked right into the model, especially for the original founders.
Okay, let's get into the nuts and bolts then. How does this actually happen? Becoming a PLC, it all hinges on one big kind of dramatic event, right? Floating shares on the stock market.
The IPO, the initial public offering, that's the moment.
And it's not just paperwork. It's a fundamental change in who owns the company. You're literally selling pieces of the business
Shares, yeah.
directly to the public.
Yeah.
To raise what the sources call share capital. It's the first time regular people, institutions, anyone really can buy a slice.
And what's really key here, I think, is the mechanism and just the sheer scale it opens up. Well, when a company floats, they're not just getting a one-off injection of cash like a loan. They're basically creating a permanent market for ownership in their company.
On market.
Yeah,
Right.
a liquid market. And they hire investment banks, underwriters, to manage this whole IPO process. They make sure the shares get sold.
Guaranteeing the money comes in.
Exactly. Guaranteeing the company gets the funds it needs for whatever big growth plan it has. And because they're tapping into potentially millions of investors, worldwide public institutions, pension funds.
So the pool of potential money is just vast.
Absolutely transformative amounts of finance, orders of magnitude bigger than what a bank could typically offer. It's a whole different league.
Okay, and just to be super clear on where this all happens,
Mhm.
these shares, once they're out there, they get bought and sold where?
On the stock exchanges, think New York Stock Exchange, London Stock Exchange, NASDAQ. These are the organized marketplaces.
Right, the venues?
They provide that essential function, a place where buyers and sellers can always find each other, figure out a price. Liquidity, basically.
And that liquidity is crucial, isn't it? Because if you're an investor putting in, say, millions,
You want to know you can sell those shares easily if you need to, right? You don't want your money locked up indefinitely.
makes sense.
Right.
So the stock exchange provides that confidence, that ability to get in and out.
Precisely. And that confidence, fueled by liquidity, is what encourages investors to put vast sums into PLCs. It keeps the whole engine running.
Okay.
And, that ability to attract all this capital ties directly into the first big advantage of being a PLC, especially from the investor's point of view: limited liability.
Ah, yes, limited liability. This is where it gets really interesting for the shareholders, the people buying the stock.
It's fundamental.
Explain what that means, limited liability.
It means the shareholders' personal finances are protected. The absolute maximum they can possibly lose is the amount they actually paid for the shares. That's it.
So if the company goes bankrupt, drowning in debt,
The creditors can't come after the shareholders' houses or personal savings. Their loss is capped, limited to their investment in that specific company.
and that safety net, that cap on risk, it's not just nice for small investors, is it? It attracts the big players too.
Oh, hugely. Think about pension funds, mutual funds, large institutional investors. They manage billions. They need this protection.
Because they can't risk wiping out their beneficiaries if one company fails.
Exactly. Limited liability makes investing in stocks scalable and manageable from a risk perspective. Without it, honestly, the stock market as we know it probably wouldn't exist. The capital flows would just dry up.
Wow, okay. So that protection for shareholders,
Hmm?
how does that translate into an advantage for the company, the PLC itself?
Well, because investors feel safer, the PLC finds it much, much easier to raise finance. And it's not just a one-shot deal at the IPO.
You mean it's ongoing benefit?
Yes, absolutely. Once you're a listed PLC, you can go back to the market again and again. You can issue more shares later on to raise fresh capital.
Right, for new projects or expansion?
Exactly. Or, because you're so transparent and regulated as a public company, you often find it easier to borrow money too, perhaps at better rates.
So it becomes this continuous pipeline for funding growth.
Precisely. Funding R&D, building factories, acquiring other companies, whatever drives that growth agenda. It's like having a permanent, powerful financial engine always available.
Okay, so we've painted a pretty rosy picture here. Huge amounts of cash, easily available, investors protected. Sounds almost too good to be true. Like an unlimited money cheat code for business.
Well, if only it were that simple. There's always a catch, isn't there?
I figured. So what's the downside? What's the price the original owners, the founders, have to pay for access to this engine?
This is where the tone shifts, definitely, because getting that PLC power comes with some really significant strings attached. For the people who built the company from scratch, it's often described as a bit of a Faustian bargain.
Trading control for capital.
In essence, yes. You get the financial firepower, but you potentially lose your grip on the company you created. The sources highlight two major risks that are just inherent in being public.
Okay, what's the first one?
The first is the external threat, the risk of takeover. Once your company's shares are trading freely on the stock market,
Anyone can buy them.
anyone, including competitors or maybe aggressive investment firms known as activist investors,
They can just start buying up shares.
yep, often quietly at first, they start accumulating shares on the open market until potentially they manage to buy enough to gain control.
How much is enough? Like 51%.
Usually, just over 50% of the voting shares gives them effective control. And this isn't usually a friendly negotiation. It can be a hostile takeover.
Hostile, meaning the original board and founders don't want it to happen.
Exactly. But if the acquiring company gets that majority stake, they can force the issue. They can vote out the existing management team, completely change the company's strategy.
Or even break up the company and sell off the pieces.
It happens. So for a founder, that's terrifying, right? The company you poured your life into could be snatched away simply because you needed capital to grow it. You made yourself vulnerable by going public.
Wow. Okay, that's a huge risk. What's the second danger?
The second risk is more internal, sometimes slower, but just as significant. The potential loss of control, often through dilution.
Dilution, you mean like watering something down.
Sort of, yeah. Remember how PLCs can keep issuing new shares to raise more money? Well, every time they do that, the ownership pie gets divided into more slices. So even if the original founders hold on to all their initial share,
Their percentage of the total ownership goes down.
exactly, their voting power shrinks. They might start with, say, 60% ownership, but after a few rounds of issuing new shares for funding, they might only own 20% or 10% or even less.
So even if they aren't taken over from the outside,
They can lose influence from the inside. Power gradually shifts from those original visionaries to this broad, fragmented group of public shareholders.
and those public shareholders might have different priorities, right? Maybe more focused on short-term profits.
Very often, yes. The market tends to focus on quarterly results, dividends, share price bumps now.
Whereas the founder might have a 5-year, 10-year vision that requires investment and maybe lower profits in the short term.
Precisely. And if the public shareholders who now collectively hold more voting power don't like that long-term, perhaps initially loss-making plan,
They can vote against it, or even vote to replace the founder as CEO.
it's a constant tension. You gain access to capital, but you become accountable to the market, to potentially thousands of owners whose main interest might just be the next quarter's earnings report. Your ability to steer the ship according to your original vision can be seriously compromised.
Okay, so summing this up, the PLC route is powerful but risky.
Definitely high stakes, high reward. It's probably the most important source of finance if a company wants to achieve truly massive global scale. But founders have to accept that getting that money means giving up a certain amount of control and security.
It fundamentally changes the ownership dynamic.
Completely. From a tightly held private structure to this widely dispersed public accountability model, you get liquidity, transparency, access to capital. But you lose that tight grip on governance.
And thinking about the source material overall, this PLC decision fits into the bigger picture of how businesses grow, doesn't it? We talk about different types of growth.
Right, like internal growth.
Yeah, where the PLC uses that share capital to fund things inside the company R&D, building new facilities, expanding its own operations,
Or the alternative is external growth.
where they use the money to buy other companies, make acquisitions, bolt on scale quickly.
And in both scenarios, whether you're growing organically from within or buying growth from outside, the sheer amount of capital needed often means the PLC structure is the only practical way to fuel that level of ambition. It's the engine for both internal and external expansion, really.
So let's recap. We've seen how the hunger for huge amounts of capital can push a business towards becoming a PLC. This grants them incredible power, easy access to ongoing finance, plus that protective limited liability for their investors. Huge advantages. But always at a cost. The constant threat of an external takeover or that slow internal erosion of control as ownership gets diluted, it's a balancing act.
It really is. Which leads to, I think, a really interesting question for you, the listener, to chew on.
Okay?
Well, think about it. The whole point of becoming a PLC, the reason founders take these risks, is to get the capital to pursue their growth vision, right?
Right. To build the company bigger, better, according to their plan.
But the very mechanism they use to get that capital going public, issuing shares, inherently puts that control, that ability to execute their vision at risk.
So the tool you use to achieve the dream might actually destroy the dream.
Or at least fundamentally alter it. So the provocative thought is this. Is there an optimal point? A point where maybe a company should stop chasing more public capital, even if it means slower growth, just to protect the original vision, the core identity, the founder's control over the direction.
Where do you draw the line between fueling growth and maintaining control over what you're growing?
Exactly. When does the pursuit of scale risk turning the founders into just employees in the very empire they fought so hard to build? Something to mull over.
Definitely something to think about, especially before you ring that opening bell on the stock exchange. Thanks for joining us on this deep dive into the complex world of public companies.
Thanks to both of you for joining us today. You've been listening to the Business Gurus. Let's now hand it over to you. What further questions do you have based on what we've discussed so far? Leave a comment and we'll get back to you right away. If you haven't already, hit that follow for more business tips.